Everyone thinks they already know what makes a coffee shop chain fail. The rent's too high. The beans cost too much. Labor's impossible to staff and impossible to keep. But that might be the wrong place to look. Because a coffee shop chain isn't really built like a coffee house. It's built more like a gym membership nobody quite gets around to canceling. You keep paying long after you've stopped showing up. The balance just sits there. And somebody somewhere is counting on that. Beans support the menu. Rent supports the real estate footprint. Labor supports the morning rush. A loyalty app supports repeat visits. And underneath all of it, a stack of money customers already handed over and haven't spent yet quietly supports the entire company's cash flow. The real danger for a coffee shop chain was never really the price of a latte. It's that the whole business can be running, in part, on money people already paid and forgot about. Here's the part that should genuinely unsettle you. Each cup poured this morning is quietly propping up a loyalty balance from last month, which is propping up a real estate footprint that was only ever justified by next year's growth, which depends on the exact same customers coming back to reload the exact same balance all over again. Welcome to Capital Invests, where money, power, and history collide. And nothing is ever as simple as it looks. The modern coffee shop chain is not built like a cafe. It's built more like a bank with a menu board. It has espresso machines, drive-through lanes, a loyalty app, and a very expensive real estate strategy nobody can quite justify with coffee margins alone. From the outside, it still looks like a warm room that smells like a pastry case. But underneath, too much of the... Here's what's actually going on underneath that idea. Starbucks makes more money every single year from gift cards and app balances that customers simply never spend than most independent coffee shops will ever make in profit across their entire lifetime. Wait, what? The company isn't just selling coffee. It's quietly running one of the largest prepaid balance pools in American retail, and most of its own customers have no idea. So, why does anyone do this? Being the third place, the spot people build their whole morning routine around, the kind of local fame that turns into real media attention and, eventually, real leverage to open a second location, then a third. That's the honest, partial answer. What it actually costs to get there is where the story turns. First, you need permission. And if you're building a real chain, not from one office, but from two separate systems that don't always talk to each other. Your local health department licenses your kitchen and your espresso equipment as a food establishment. Separately, the moment you try to franchise or expand into new states, the FTC's federal franchise rule and a cluster of individual state franchise registration laws both require their own disclosure filings before you're legally allowed to sell someone else the right to open a second store under your name. And the capital required escalates fast depending on the format you pick. A drive-through-only coffee kiosk can open for as little as $150,000 in a small market. Push into a premium metro location with a full build-out, and that same drive-through format can run past $1.5 million before you've served a single cup. And here's a rule most people don't know about. Dutch Brothers, one of the fastest-growing drive-through coffee chains in the country, has completely closed its franchise system to outside applicants. You cannot buy in from the outside at all, no matter how much capital you have. Every single franchise operator today started as an internal employee, a barista, who worked their way up through the company first. The dream of simply buying your way into a hot coffee brand doesn't exist here, by design. You also need people, real, specific, sometimes legally mandated people. Every location needs a certified food handler on shift. Fire marshals require specific inspection and certification for the high-pressure boiler systems inside commercial espresso machines. And in a genuine drive-through format, most jurisdictions have their own queue length and stacking lane regulations that can quietly disqualify a piece of real estate you already fell in love with. So that's the entry fee, just to legally exist. Now let's talk about the actual product, the format itself, because here you face the real fork in the road that defines this entire industry. The drive-through-only kiosk, built for speed and volume, or the full cafe third place model, built for people to sit down and stay. And here's the first trap. They open a coffee shop for $150,000. Headlines you see online almost never reflect what a real, competitively located store actually costs. Prime real estate for a coffee brand routinely runs the total investment up past $1 million once construction, permitting delays, and equipment are all counted honestly. Move from a small market kiosk to a full-service cafe with seating, and the numbers get considerably more painful. A drive-through kiosk can be built on a small footprint with modest equipment. A full cafe needs HVAC sized for a room full of people, furniture, restrooms, and enough seating capacity to justify the extra square footage, easily doubling or tripling the build-out cost of the exact same brand's drive-through format. Here's where the first real decision point shows up. Do you buy the land your coffee shop sits on, or do you lease it? Most operators lease, and most of those leases are triple net. You cover rent, taxes, insurance, and maintenance, all stacked on top of the base rent itself. Cheaper to sign, more expensive to live inside. A percentage lease is the alternative, a lower base rent, but the landlord takes a cut once your sales cross a threshold, meaning the better your store performs, the more of that upside quietly goes to someone who never poured a single espresso shot. There's also a real estate trick that's become common in the drive-through coffee boom. A third-party developer builds the kiosk to your exact specifications on a hot corner, then leases the finished building back to you at a fixed rate. It's completely legal, extremely common in this exact format, and it lets a growing chain expand fast without tying up its own capital in dirt and concrete. It also means a meaningful share of your fastest-growing locations were never really yours to begin with. You're renting the very success you built. So now you've got a format and a lease structure. Time to pick a business model, because coffee shop chain isn't one business, it's at least three completely different ones. The drive-through-only kiosk model, pioneered at scale by brands like Dutch Brothers and Scooters, is built entirely around speed and throughput, small footprint, minimal seating or none at all, and revenue-driven almost entirely by how many cars you can process per hour during the morning rush. Then there's the full cafe third place model, the one most people picture when they hear coffee shop chain. Comfortable seating, Wi-Fi, people working for hours on a single small coffee. Higher average ticket per visit once you count food and add-ons, but a dramatically higher real estate and labor cost to support all that lingering. And there's the hybrid express model, a small branded counter operating inside someone else's retail space, a grocery store, an airport terminal, an office lobby. Lower build-out cost and built-in foot traffic, but you're now a licensed guest inside somebody else's real estate, subject to their lease terms and their hours, not yours. This brings us to one of the strangest hidden assets in the entire industry, the corner itself. A handful of intersections in any given city carry the specific traffic pattern, the right turn-in visibility, and the stacking lane depth that make a drive-through genuinely work. Multiple competing chains regularly bid against each other for the exact same handful of qualifying corners in a market, driving land and lease costs for those specific parcels far above what ordinary retail real estate commands nearby. Now let's get into the costs that actually eat your revenue every single day. This is where most people's mental math falls apart. Combine your cost of goods with your labor, and prime cost on a well-run coffee shop typically lands between 60 and 70% of revenue, meaning before rent, before equipment payments, before a single utility bill, you've already given up 2/3 of every dollar that came through the register. Labor is the single biggest recurring cost, and it's become one of the most contested corners of the entire industry. Baristas across major chains have organized union campaigns in recent years, citing understaffing during rush periods and wages that haven't kept pace with the pace of the job itself. A genuine, ongoing labor tension playing out storefront by storefront, city by city. And behind the counter, the job itself is more physically demanding than most customers ever consider. Steaming milk, working a register, and handling a drive-through headset simultaneously during a 15-minute morning rush that can determine whether that store hits its numbers for the entire day. Coffee itself is the second biggest cost, and it's where volatility genuinely lives. In February 2025, Arabica coffee futures hit $4.41 a pound, the highest price since 1977 and roughly 70% higher than a year earlier, driven by drought in Brazil and crop damage in Vietnam, the world's two largest coffee-growing regions. That spike didn't stay on the trading floor. Retail coffee prices in U.S. stores rose 41% year-over-year during the same stretch. Some chains tried locking in supply contracts early to protect their margins from exactly this kind of spike, and depending on the timing, that decision either saved them a fortune or locked them into paying above market prices for a year on beans that had since gotten cheaper. One coffee company tried something that looked, at the time, like an unnecessary distraction from making coffee, and it became the most important decision the company ever made. Long before mobile ordering was standard anywhere in retail, Starbucks poured serious investment into its own rewards app and mobile order ahead system, spending on software and engineering that some analysts questioned for a company whose actual product was a cup of coffee. That app didn't just speed up the line. It became the entire foundation of the loyalty and stored value engine that now drives a meaningful share of the company's real financial strength. Maintenance in this business runs on an unforgiving clock. A commercial espresso machine's boiler failing during the Monday morning rush doesn't just cost a repair bill. It means turning away your highest value hour of the entire week while a technician is still an hour away. And beyond the espresso machine, ice machines, cold brew taps, and drive-through order point equipment are their own recurring gulf. Each one a piece of specialized hardware that eventually fails without warning, and each one capable of quietly shutting down an entire product line until it's fixed. Then there's insurance, general liability, property, and workers' compensation, layered underneath equipment financing costs that most first-time owners underestimate until the first machine breaks down outside of warranty. And like every corner of the food and beverage business, coffee chains chase savings in places that look almost comically small on their own, trimming a fraction of an ounce of milk off a steaming routine, standardizing pour amounts down to the gram, trivial per cup, but multiplied across thousands of drinks a week, it adds up to real money by the end of the quarter. So, that's the cost side. Now, let's talk about how you actually make money back, because this is where the story gets genuinely interesting. Every part of the ordering experience is engineered, deliberately, to move you toward the higher margin item without you ever quite noticing. Seasonal drink drops create real, manufactured urgency. A limited time flavor is not just a menu item, it's a countdown clock designed to get you to visit before it disappears. The mobile app pushes this further, suggesting an upsized drink or an add-on at the exact moment you're already committed to buying something, collecting your order history to personalize the next nudge, and quietly training you to open the app before you even think about walking up to the counter. You've been nudged at the register more times than you probably realize. The break-even math behind all of this is brutal. With prime cost eating 60 to 70% of revenue before rent, a drive-through location has to process a genuinely high number of cars per hour during a narrow morning window just to clear its fixed costs for the day, which is exactly why the difference between a great corner and a merely good one can be the difference between a thriving store and one that never quite gets there. Beneath the daily cup sales, ancillary revenue matters more than people assume. Bagged retail coffee sold in grocery stores, branded merchandise, and office and catering contracts all add predictable income that doesn't depend on a single morning's foot traffic. But here's the part almost nobody outside the industry understands, and it's the single most important structural fact in the entire business. The real profit engine of a major coffee chain often isn't the coffee at all. It's the money sitting unused in customer accounts, money you already handed over that the company gets to hold interest-free until you spend it, or never spend it. As of the end of fiscal 2025, Starbucks was holding just over $2 billion in stored value and loyalty program liabilities on its balance sheet at any given moment, an interest-free loan from its own customers. And in a single recent fiscal year, the company recognized over $220 million in pure profit from balances that customers simply forgot, lost, or never got around to spending. That's not a rounding error. That's a business line most coffee drinkers have never once thought about. In a very real sense, a coffee chain with a loyalty app and a gift card program has become a small, unregulated bank wearing an apron, collecting deposits, extending itself interest-free credit, and quietly recognizing forgotten balances as profit, all while the actual store upstairs runs on a margin thin enough to be wiped out by one bad lease. Now for the volatility. Even the largest player in the industry isn't immune to it. Starbucks closed roughly a dozen U.S. locations in 2025 alone as part of a billion-dollar restructuring effort that also cut hundreds of corporate jobs, aimed squarely at improving profitability at a chain most people assume is simply printing money. Peet's Coffee, a smaller rival, ended 2024 with fewer stores than it started the year with, and sits well below where it stood before the pandemic, a reminder that brand recognition alone doesn't protect a coffee chain from a business environment where rising costs and shifting customer habits can quietly erode a footprint built over decades. Compass Coffee is the clearest recent example of what happens when all of this compounds at once. The Washington, D.C. area chain expanded aggressively, including acquiring 21 locations of a specialty UK roaster in a single 2024 deal, right as coffee costs were spiking to their highest levels in nearly 50 years. By January 2026, the company had filed for Chapter 11 bankruptcy, closing 10 of its locations outright while the rest sat at risk, before a British coffee company ultimately won the company's remaining assets at auction for under $3 million. Expertise and brand recognition didn't protect it from an expansion pace and a commodity spike hitting at exactly the same time. A quieter kind of volatility has been building for years and gets far less attention. Coffee chains built their entire morning rush economics around commuters driving to an office 5 days a week. The shift toward hybrid and remote work permanently softened that exact traffic pattern in a lot of markets, and a location that once thrived on an 8 a.m. commuter rush now has to survive on foot traffic that simply isn't showing up the way it used to. Ingredient and packaging costs are the newest volatility factor on the list. Rising demand for oat milk and other alternative dairy options has pushed real ingredient costs higher across the industry, and a growing number of cities have begun taxing or restricting single-use disposable cups outright, forcing chains toward reusable or compostable alternatives that cost meaningfully more per unit. So, let's run 2 scenarios. In the optimistic one, you land a genuinely qualifying high-traffic corner, build real loyalty and stored value revenue the way Starbucks did, and run a lean enough labor model to clear a healthy margin even as bean prices swing. In the realistic one, you expand faster than your unit economics can support, get hit by a commodity spike at the exact wrong moment, and carry acquisition debt into a downturn, the way it played out for Compass Coffee, sold off in bankruptcy for a fraction of what it once cost to build. So, if you still want to own a coffee shop chain, understand exactly what you're actually buying. Not really a warm room that smells like espresso. What you're buying is a thin operating margin sitting on top of a real estate bet, propped up by a stack of money your own customers already handed over and haven't spent yet, the exact gym membership nobody canceled. Except this time, you're the one collecting the balance. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.